Hello everyone and welcome back to my channel. If you're new, my name is Alea. Everyone calls me Lay, so it's me, Lay. If you're returning, what's up y'all? So as you can see from the title of this video, today's video will be called, What is interest? Let's get into Webster's definition. Or Google, who's keeping track? Google says, in finance, interest is a payment from a borrower or deposit taking financial institution to a lender depositor of an amount above repayment of the principal sum at a particular rate. It is distinct from a fee which the borrower may pay the leader of some third party. Now, I know that sounds like a lot, but let me break it down for you. In my definition, interest is the lowest amount you would pay before paying your actual credit off. What do you mean by that, Lay? Here's what I mean by that, Lay. Let's say that you're behind a payment of $100. Now, more than likely, you would receive a notice in the mail by the bank that says that you have until the end of the month to pay off a minimum fee. Usually, you would receive this notice if you haven't made a payment in more than 2 weeks. Now, like I said, they would send you a notice of you having to pay a minimum amount. Usually, that minimum amount might be like $20. But that, my friends, is not the minimum amount of the credit. That is your interest. So the problem with that is if you only ever pay your minimum amount, then you will initially never actually pay off your initial credit amount. You will only be paying off your interest time and time again. There are also many different types of interest. You have your fixed interest, variable interest, annual percentage rate, discounted interest, compound interest, and simple interest. First, I want to explain your annual percentage rate. This is the most common interest rate that you'll ever see. Mainly because this is a usual credit cards company's mode of payment methodology. Credit card companies will apply this method when a customer carries forward their balance instead of paying it off fully. So basically what I just said. Now, a fixed interest rate is also common, but mainly you will see this interest rate if you were given a loan. So a fixed interest rate basically means that your interest will never fluctuate over time, meaning it will never go down or go up. Now, a variable interest rate is the exact opposite of a fixed interest rate. Typically, this interest rate gets lower, and it all depends on the movement of the base level rate interest. On the base level interest rate, or the prime interest rate, which is a method that banks use to set up a bias of different loans and types of credit cards. Now we're going to move on to discounted interest rate. Now, this rate of interest is mainly only used for federal banks. They use this to lend money to other financial institutions. By doing this, they are covering up their lending capacity, and they do this to prevent a bank crisis. A simple interest is simply a simple rate of interest that banks will use to charge their customers. You see how I did that? Yeah, I know. Basically, let's say you get a loan for $1,000, and the interest rate per year is 10%. Now, I'm no mathematician and this isn't rocket science, but if you take that 10% from 1,000, then that's only $100. But let's say that you have to pay off this loan in a span of 3 years. So to pay off this loan, you have to pay $300 every year. And that's a simple interest rate. Now, last but not least, we have our compound interest rate. The compound interest method can be referred to interest on interest. This is used for banks to calculate rates. The rate will be the interest of an actual loan and the amount that is for the initial loan, which is referred to as the principal amount. So first they'll apply the interest of the loan and then the loan balance, or the principal amount. And then whatever that loan balance is, or principal amount, the bank will also use that same principal amount to calculate the subsequent yearly interest rate or interest payment. Now, I know this video was short, but I don't remember which credit video it was, but I said that I would get into interest in another video, and here is that video. So I really hope you enjoyed it, and I hope this taught you a little bit about what interest is and how many different types of interest there are, because a lot of people really just don't know. And shoot, I didn't even know before I made this video. Google is my best friend. I will not lie to y'all. Don't forget to like, comment, and share this video with a friend, and I will see you in the next video. Peace. So first they'll apply the loan balance. Wait, what? Let's say you are behind a payment. What? First I want to explain your annual interest is the lowest amount of, in finance, Interest is payment from a borrower or deposit taking financial institutions. Oh my gosh, following the script is so difficult. A simple interest is simply just a simple interest rate is simply that, mainly because these are what most credit card companies use as their methodology to what? A simple interest is mainly because these are what credit card companies mostly use as their mode of payment method. A simple interest is simply a simple way that banks will use. A simple interest is simply a simple rate of interest. Are you even recording? You are. Okay. Mainly because this is a usual credit cards company's mode of payment methodology. And see. Thank the heavens. You ever try to follow a script that you just wrote that day? Man, this was a workout.